Welcome to OpalesqueTV. I'm now together with Jim Hedges. When I started Opalesque in 2003, Jim already had his fund-to-fund going for 11 years. So he started in '92. So he has been a veteran hedge fund investor who along the way also started to collect art. After collecting art, he made a transition to invest in art. And I'm curious to hear now more about from Jim, what has been your career from hedge funds to a collector to investor in art?
Thanks so much for having me on. It's exciting to talk about my art investing activities. You know, when I started investing in hedge funds in the early 1990s, it was a place where people really went for returns because it was sort of a relationship-driven world. It was not very transparent. It had a lot of pitfalls. It was difficult to understand, and a lot of those markers are the same in the art world today, where there's not a lot of transparency. It is very much a relationship-driven type of world, but there are huge outsized return opportunities there. I had started originally because I was a collector. I started collecting art when I was very young, originally in photography, and then moved on to different areas. And in the course of doing that, you get more and more educated, and you start to see where there's relative value that looks interesting. I also had a really nice thing in my business, in my core investment business, where a lot of my clients were also art collectors, and so I learned from them as well. Ultimately, what I found was that the art world was probably the largest unregulated financial asset out there in the world. You know, you're looking at a sector that has about $50 billion a year of turnover. So there's an enormous amount of volume of transactions going on. You also have a dynamic where the real investable universe of art is actually fairly small. You know, if you go and look at auction catalogs from Christie's and Sotheby's and Phillips, you'll get the lion's share of the names of artists who have defensible liquid markets for the work that they make. So there's a big universe, the $50 billion a year, there in terms of volume, and then there's a small universe, relatively speaking, in terms of the number of artists, or I could even describe them as securities. And then you start thinking about the ways in which you can assess value. And the lessons I learned in the fund-of-funds business or in the hedge fund business are very much applicable to the art world. You know, I'll tell you a few examples of what I've done. You know, going out to identify artists that have, you know, an undervalued position relative to their peer group. So the old notion of hedge fund relative value trade. Well, you know, I started studying different artists and their peers, and I started seeing that there were huge valuation disparities between this blue chip artist and this equally blue chip artist, but whose market just hadn't seen the appreciation in the United States, for instance, and therefore was at a great discount. Identifying those types of artists, for instance, in this example, Gerhard Richter, abstract German artist, and Sigmar Polke, another artist of the same vein and same generation, this was very interesting to me. So I went long Sigmar Polke and saw a great deal of price appreciation over the past 5 to 10 years. Likewise, I love to look at artists and try to get a sense of the value associated with each of their bodies of work. So artists work across medium. So an artist may be a painter. He or she may make works on paper and drawings, may make sculpture, may make photographs, etc. So I very frequently have found great investment opportunities by looking at tier 1 blue chip artists and then assessing the relative value within their portfolio of work that they make and finding interesting segments that were dramatically undervalued. I've gotten very active, in particular in the Andy Warhol photography market. Warhol photography was central to the artist's art-making process. He began in the 60s with photographs, Times Square photo booth strips, where he would take subjects into a photo booth and create these serial images of them and then turn them into paintings. He began working with a Polaroid, then he worked with a 35mm camera. All along those years, those 3 decades, 60s, 70s, and 80s, the artist was utilizing photography as source material for making prints, making works on paper, making paintings. So I knew it was terribly important, but I also looked at it and I saw that prints, of which the artist made maybe 250 of a particular type of image, prints were trading at far higher value than the photographs, which were unique objects, not produced in multiples. So that to me was very interesting, that you could go out and buy one of 250 and that might cost $25,000 or $50,000 versus you could buy a unique object for maybe $5,000 or $10,000. So that valuation disparity needed to correct. And it's begun the process of correcting. So I invested heavily in Warhol photographs, built a large collection. It's been said the largest private collection in the world of Warhol photographs. And now I've been really monetizing that over the course of years by selling at art fairs and different channels. These are the types of things that are very interesting to me. I applied the same rationale to the artist Cy Twombly, obviously one of the greatest artists of the 20th century, one whose paintings go for, in many cases, if not most cases, well north of $5 or $10 million. His works on paper now usually over $1 million, but his photographs had been completely undervalued and underappreciated, just understudied. So that contrarian view of looking at something is also very applicable to all types of investing, including art. I found that with Cy Twombly photographs, these things had been trading for $10,000, $12,000 a piece, and they were wonderful objects. They were objects that should be priced more like their peers and more in keeping with the artist's other body of work. So since I began investing in Twombly photographs, they've gone up, more than 5-fold, and in some cases even much more. So these are the types of things that I like to look at. What's contrarian? What is a strategy where you can find something undervalued within a very valuable artist's body of work? Or how does this artist compare to this artist? And is there such a valuation disparity that it should probably consolidate in the future?
So Jim, this is fascinating. I wonder, how does one participate in this market? What are the tools that are needed to do that?
Malcolm Gladwell's book, Outliers, talks about the 10,000 hours that you need to log in order to become an expert, right? So whether it's flying an airplane or whether it's, learning a foreign language, etc., it requires a tremendous investment of time. The art world is actually a fairly easy place to learn because, as I mentioned before, there are art fairs, there are auction houses, there are galleries, and obviously museums. So the main thing that people have to do to get engaged is to actually study the material. And once one studies the material, develop a point of view about what it is you'd like to or feel most comfortable investing in. What I've started to do is look at data analytical tools in this space. There is such a dearth of information available on the value of artwork that there's a real opportunity. So what I've been doing recently is looking at resources that use machine learning to analyze historic performance and predict the valuation of a particular artwork. And in the process of using these machine learning tools, we're also able to identify momentum characteristics. We're able to identify a group of other factors that will tell us when sentiment is changing, when there is momentum behind an artist's body of work, and things of that nature that will drive price appreciation. Similarly, it helps us identify when auction houses miss on their estimates. And that's been a very powerful tool as well, because we can tell if something is going to be bought in, meaning not sell. We can tell when something, is going to go dramatically over the estimate because the auction house lowballed it in order to encourage a lot of bidding. But going back, taking a step back, if one wants to get into the art world as an asset class, as a store of value, as an alternative investment, the best way to do it is to identify both a capital allocation that would be appropriate, then go and seek out expertise that will help you identify those artists that exhibit these characteristics I've talked about: relative value to their peers, relative value within their own body of work, that have the benefit of being assessed very attractive values using machine learning, and then allocate the portfolio, allocate the capital to build a portfolio over the course of time. Because not dissimilar from venture capital or private equity, investing across a longer time span is actually a very effective tool of making sure that you insulate yourself against market volatility in the near term.
So if one wanted to go into art and follow these relative value trades and interesting opportunities that you've just described, how much money do you think is needed? And then secondly, how should those people then be diversified?
It's been very interesting to think about these questions, because it's a similar discussion that I had 25 plus years ago when talking about hedge fund investing with people. You have to decide how much capital you're willing to put to work in the space. You have to decide what that can buy you, or assess what that can buy you. Then you have to look at the appropriate mechanism to get exposure. So when I started in the fund of funds business, it was very clear that managers had high minimums, many managers were closed, and if you wanted access and diversification, frequently you were driven to a fund of funds vehicle. So that became the mechanism through which so many people participated in the hedge fund world. The art world is sort of similar. You've got this very, very large financial asset class, you've got lots of volume going on, but not many people are going to buy $100 million paintings as an investment. So how does one participate in a diversified way that gives one access to superior, material? So I essentially work with people on one of two different paths. Either I work on a managed account basis to build an allocation to art for a family or a private bank, and when I've done that, it's been usually started off around $5 to $10 million of capital being allocated, because at that level you can build sufficient diversification and breadth of exposure. The other thing, though, is that I'm launching an art fund, which will have the benefit of aggregating investor capital into a larger pool so that larger dollar items can be bought and greater diversification can be achieved. But at the end of the day, if somebody wants to invest in the asset class that is called art, you're probably looking to invest greater than $1 million, more than likely at that level through a fund. But if you have the ability to aggregate capital to $5 or $10 million, you could get a customized managed account, which would effectively serve as a direct exposure. Let me also touch on another aspect of investing in art. What I've described up to this point has been focused on equity, meaning owning artwork directly. You can also invest in the art world through debt. And it's a very interesting dynamic. I had a business that provided loans to private dealers and private collectors for many years. And what we would do is go out and provide banking services to these individuals that did not want to borrow against their securities portfolio at their private bank. They did not want to be able to, tap other sources of liquidity, but they wanted to get some value for short-term cash purposes to taken against their fine art portfolio. So in the process of talking to people about art loans, I found that number one, art loans were very oftentimes being sought out by people that really just wanted to sell. And if somebody really wants to sell or really needs to sell, sometimes there's a distressed investment opportunity. So while I was flying the flag of being an art lender, very oftentimes people would come in and I would present a certain set of terms. They would say, well, but I really want to achieve something else. I'd really like to sell the piece. And then you make another offer. And many times I've been able to pick up assets at dirt cheap valuations. So there is a continuum. There is buying artwork, which is effectively a long-only equity play. There's lending money where artwork is your security and you're lending to, at very high interest rates that are being paid on a current basis. And then finally, that art lending business usually uncovers opportunities in distressed assets. So there are three distinct ways to play here.
So Jim, art funds aren't really new, right? They have been around for a while. But tell us, how have they been doing as a category or as a sub-strategy?
The thing with the art fund universe that's existed heretofore is that they have not been operated as asset management products, investment products. So you've seen lots of things that are troubling that don't really fly in the investment world, like a lot of conflicts of interest. So many of these funds are also brokering products themselves. So they're taking commissions when they're buying and selling for the fund. Many of these people have structured their businesses in a way that have enormous fees associated with them, whether it's fees for shipping and insurance and storage or management fees, but very burdensome fee loads. That's no good. We live in a world of transparency where people expect a fiduciary to be a fiduciary. We think that there's a lot of opportunity to create a fund business that is differentiated in having best practices in due diligence and underwriting, best practices in marketing and PR, and looking to monetize the assets through partnerships. And that's really not been done to date. So my background of being an asset manager in the fund-to-fund space really informs my art investing activities because the importance of sound operational excellence is paramount in investing, just as it is in the art world. The importance of underwriting securities properly, of assessing value, of assessing momentum, these are skills that are directly applicable to this landscape. So you really need to have somebody guiding the ship that has a financial orientation as well as an art world understanding and sophistication. So the lessons that I learned in the hedge fund landscape apply directly to this art fund activity. You need to be able to assess artists for their value. You need to be able to assess the operational risks and costs associated with making the investment. You need to be able to look at all different types of strategies, whether it's owning outright the equity, lending money to art collectors as art loans, or buying distressed assets. That flexibility of moving across the asset classes or moving across the strategies is really central to a successful fund. Like many segments of the investment world that are not well understood, the art world is prone to sensationalism as well. You hear people talking about emerging artists that have huge run-up in value and people get involved in a very speculative way and then things blow up and it's a bad part of the market. Similarly, you hear these stories about the $100 million, $200 million paintings, and people think that's indicative of the art market. The art market I'm talking about investing in is one in which one can build an investment portfolio that is multi-strategy across different sectors, different types of artists, with artists whose work is highly liquid and has a long-established track record. There is a universe of probably 1,000 artists that fit that criteria. And among those artists, you can utilize both subjective as well as quantitative tools and machine learning to identify great opportunities for value.